What if I told you that you could start building serious wealth through real estate, without a license, without a six-figure salary, and without owning a single property up front? I know it sounds completely insane, right? The kind of thing you hear in those late-night infomercials that promise you the world, but only deliver a flimsy pamphlet. For most people, the idea of real estate investing brings to mind massive down payments, complicated bank loans, and needing a team of lawyers on speed dial. But what if the entire barrier to entry you've been taught to believe in is, for the most part, a complete myth designed to keep regular people out of the game? What if the path to financial freedom was hiding in plain sight this whole time? Sounds impossible, right? Well, let me tell you, it's not. In fact, it's more possible now in 2025 than ever before. Thousands of everyday people, I'm talking about Uber drivers, baristas making your morning coffee, plumbers fixing your sink, and regular 9-to-5 workers sitting in the cubicle next to you, are quietly making thousands of dollars every single month, sometimes even every week from real estate investing. And here's the kicker, the part that really blows people's minds. Some of them are starting with literally $0 in their bank accounts. They aren't using family money or some secret inheritance. They're using specific, repeatable strategies that leverage other people's money and other people's properties to build their own fortunes. In this video, I'm going to break down exactly how they're doing it. I'm going to show you, step by step, how to start real estate investing from scratch. We're going to dive deep into the different types of real estate income strategies, from the ones that require no money down, to the ones that let you invest with the spare change you find in your couch cushions. My goal here is simple: to give you a complete blueprint on how to build long-term, sustainable wealth and achieve true financial freedom using the unparalleled power of real estate. This isn't just theory, this is a practical guide for the modern world, for right now. And to prove it, I'm bringing the receipts. We're going to look at real, current stats that show just how powerful and accessible real estate is in 2025. This isn't about daydreaming or wishful thinking, it's about taking decisive action based on proven methods. So, if you're tired of living paycheck to paycheck, sick of watching your savings get eaten away by inflation, and you're finally ready to take control of your financial future, then this is the video you've been waiting for. I promise you, the next few minutes could genuinely change your life. So smash that like button for the YouTube algorithm, and let's get into it. Alright, let's kick things off with the #1 undisputed champion of no money down real estate investing: wholesaling. If you've ever thought, I have absolutely no money so I can't invest, this is the strategy that shatters that belief into a million pieces. Wholesaling is, at its core, the art of the deal. You're not buying houses, you're not flipping them, and you're certainly not becoming a landlord. Instead, you're a deal finder, a matchmaker, a real estate detective who gets paid handsomely for connecting a motivated seller with a ready and waiting cash buyer. It's the purest form of profiting from information and negotiation skills, not capital. So how does it work exactly? It's surprisingly simple in concept, though it does take hustle, which is why so many people overlook it. Your job is to find properties that are undervalued. I'm talking about the houses with the overgrown lawns, the peeling paint, the ones that look a little neglected. These are often owned by people who are motivated to sell quickly. Maybe they inherited the property, are facing foreclosure, or are just tired of being a landlord. You approach the owner, negotiate a purchase price that's below market value, and get the property under contract. But here's the magic. You have no intention of actually closing on this deal yourself. Once you have that signed purchase agreement, you've secured an equitable interest in the property. This piece of paper is now a valuable asset. Your next step is to find an investor, usually a house flipper or a landlord with a pile of cash, who is looking for exactly this kind of deal. You show them the property and your contract, and you offer to sell them your rights to that contract for a fee. This is called an assignment fee, and it's your profit. The investor steps into your shoes, closes on the property with the original seller, and you walk away with a check at closing, often without ever putting a single dollar of your own money into the transaction. And we're not talking about a small finder's fee here. The typical assignment fee in wholesaling can range anywhere from $5,000 to $25,000, and sometimes even more on a really good deal. Think about that for a second. Finding one deal a month could completely replace a full-time income for many people. It's a powerful way to generate significant chunks of capital that you can then use for your own down payments on rental properties later on. It's the perfect entry point because you're learning how to find deals, how to evaluate properties, and how to build a network of investors, all while getting paid. Now, I know what some of you might be thinking. Okay, Graham, this sounds great in theory, but does it actually work? Are people really doing this? The answer is a resounding yes. This isn't some niche underground strategy. It is a massive, thriving part of the real estate ecosystem that flies under the radar for most of the general public. You don't see HGTV shows about it because it's not as glamorous as swinging a sledgehammer, but financially, it can be just as, if not more rewarding. Especially when you're starting from zero. It's the gritty, behind-the-scenes work that fuels the flippers and landlords you see everywhere. Let's look at the data, because numbers don't lie. According to recent industry reports, over 45,000 wholesaling deals were closed last year in the United States alone. That's 45,000 times that someone, somewhere, connected a seller to a buyer and walked away with a check for thousands of dollars. And here's the most empowering part of that statistic. A huge portion of those deals were done by individuals who had no real estate license. In most states, you don't need to be a licensed agent to wholesale because you're not selling the property itself, you're selling your rights to a contract, which is a key legal distinction. This is a complete game changer because it removes one of the biggest perceived barriers to entry. You don't need to spend months studying for an exam or paying expensive licensing fees. You can literally start today. You can start by driving around your own neighborhood looking for distressed properties, a practice investors call driving for dollars. You can search public records online for signs of pre-foreclosure or absentee owners. The information is out there, and the opportunity is available to anyone willing to put in the effort to learn the process and take consistent action. The beauty of wholesaling in 2025 is that technology has made it even more accessible. There are software tools that can help you find motivated seller leads, apps that can help you estimate repair costs, and online communities where you can find cash buyers in any market in the country. You could theoretically run a wholesaling business from your laptop in a coffee shop. It's the ultimate hustle. It proves that in real estate, your resourcefulness is infinitely more important than your resources. If you have the drive but not the dollars, wholesaling is your ticket into the game. So, how do you go from watching this video to actually cashing your first assignment fee check? Let's break down the action plan. Step 1 is education, but I don't mean getting a degree. I mean immersing yourself in the world of wholesaling. Spend the next week watching every YouTube video you can find on the topic, listening to real estate podcasts on your commute, and reading blogs. You need to understand the terminology, the process, and the potential pitfalls. Learn about assignment contracts, how to calculate an after-repair value, or ARV, and the 70% rule that investors use. Your initial investment is your time, not your money. Step 2 is to start building your buyers list before you even have a deal. This is where so many beginners go wrong. They find a great deal and then scramble to find someone to sell it to. Don't do that. You need to have your buyers lined up and ready to go. You can find them at local real estate investor meetups, which you can find on sites like meetup.com or Facebook. Go there, introduce yourself as a new wholesaler looking for deals, and ask every investor you meet for their buying criteria, what zip codes they buy in, what kind of properties they want, and what kind of returns they need. Get their name, email, and phone number, and put it in a spreadsheet. This is your goldmine. Step 3 is to start marketing for sellers. This is the work part of the equation. As I mentioned, driving for dollars is the free, classic way to start. Get in your car, drive through neighborhoods, and write down the addresses of any house that looks vacant or unkempt. Then you can use online tools, some free and some paid, to find the owner's contact information. You can also look for sale by owner signs, or search online for properties that have been sitting on the market for a long time. Your goal is to find someone who has a problem that selling their house at a discount can solve. Finally, step 4 is making offers. This is where the fear kicks in for most people, but it's the only way to get a deal. You have to pick up the phone, talk to sellers, and present your offer. You will get a lot of no's, and that's perfectly fine. You only need one yes to make $5,000 or $10,000. Once you get that yes and a signed contract, you immediately blast an email out to your buyers list. Hey, I've got a 3-bed, 2-bath property under contract for $150,000, needs about $20,000 in work, and it'll be worth $220,000 when it's done. I'm assigning my contract for a $10,000 fee. The first buyer to say yes gets the deal, and you're on your way to the closing table to pick up your check. Alright, our second strategy is one of my all-time favorites because it attacks the single largest expense in most people's budgets: housing. This strategy is called house hacking, and the concept is as brilliant as it is simple. You buy a property, live in one part of it, and rent out the other parts to tenants. The rental income you collect from your tenants then pays for some or all of your mortgage payment. In the best-case scenarios, your tenant's rent covers your entire mortgage, taxes, insurance, and even some repairs, allowing you to effectively live for free. It's like having your cake and eating it too. Think about the financial impact of eliminating your housing payment. For the average American, that's like getting a 30 to 40% raise overnight. All of that money you were previously sending to a landlord or a bank can now be redirected towards paying down debt, investing in the stock market, or even better, saving up for your next real estate deal. This is how you can turbocharge your path to financial independence. Instead of your home being a liability that drains your bank account each month, it becomes an asset that builds your wealth and pays for itself. It's a fundamental shift in how you view your primary residence. The most common way to house hack is by purchasing a small multifamily property, like a duplex, triplex, or a fourplex. You live in one unit and rent out the other 1, 2, or 3 units. This is the classic, time-tested model, but the definition of house hacking has expanded in recent years. You can also house hack a single-family home by renting out the spare bedrooms to roommates, or you can buy a house with a finished basement or a separate in-law suite and rent that out. The core principle is the same: use someone else's rent payments to subsidize your own living expenses. This strategy is the perfect stepping stone from being a renter to a full-blown real estate investor. It eases you into the world of being a landlord because your tenants are right next door, making management much simpler. You learn how to screen tenants, sign leases, and handle maintenance requests, all on a small, manageable scale. You're getting a real-world education in property management while simultaneously building equity in an appreciating asset and drastically reducing your personal expenses. It is, without a doubt, one of the most efficient wealth-building tools available to the average person. Now, the big question that always comes up is, this sounds amazing, Graham, but I don't have 20% to put down on a property, especially a multi-family property, which is more expensive. And that is a perfectly valid concern. If you were trying to buy this as a pure investment property, you would absolutely need a massive down payment, probably 20 to 25%. But here is the secret sauce of house hacking. Because you are going to live in the property, you can use owner-occupant financing, which has incredibly favorable terms. You're not an investor in the bank's eyes, you're just a home buyer. The most popular loan for first-time house hackers is the FHA loan, which is backed by the Federal Housing Administration. With an FHA loan, you can purchase a property with as little as 3.5% down. Let me repeat that because it's so important: 3.5%. On a $300,000 duplex, that's a down payment of just $10,500, not the $60,000 a traditional investor would need. This immediately puts property ownership within reach for so many more people. It's a government-backed program designed specifically to help people with lower savings and less than perfect credit become homeowners. But it gets even better. What if you don't even have that $10,500 saved up? You're still not out of the game. There are thousands of down payment assistance programs and grants available at the state, county, and city level designed to help people cover their down payment and closing costs. These are programs that will literally give you free money to buy a house, often in the form of a forgivable loan or an outright grant. You can find these by simply Googling down payment assistance programs in your state or by talking to a knowledgeable mortgage lender who specializes in these types of loans. So, let's put this all together. You can get an FHA loan for 3.5% down. You can then get a grant to cover that 3.5% down payment. This means you could potentially get into your first house hack property for close to $0 out of your own pocket. It sounds too good to be true, but it's a reality that thousands of people take advantage of every year. The key is that you have to live in the property for at least 1 year to satisfy the loan requirements. After that year is up, you can move out, rent the unit you were living in, and go do it all over again with another property. This is how real estate empires are built from the ground up. So, we've established that you can live for free by renting out the other units in your multifamily property, or the spare rooms in your house on a long-term basis. That alone is a financial superpower, right? But, for those who want to take their house hacking to the absolute next level, there's an even more lucrative pro tip that has just exploded in popularity, especially in 2025, using short-term rentals like Airbnb. Instead of renting your spare room or extra unit to a long-term tenant, you furnish it and list it on platforms like Airbnb or Vrbo for nightly or weekly stays. The income potential here can be honestly astronomical compared to a traditional lease. A room that might rent for $800 a month to a long-term tenant could potentially generate $100 a night on Airbnb. If you rent it out for just 15 nights a month, you're already at $1,500 in revenue, nearly double what you would have made otherwise. In popular tourist areas or cities with a lot of business travel, it's not uncommon for a single Airbnb room to generate more income than the entire mortgage payment on the house. People are literally getting paid to live in their own homes. This strategy is particularly powerful for house hacking a single-family home. Let's say you buy a 3-bedroom house. You live in the master bedroom and you list the 2 spare bedrooms on Airbnb. You're sharing your kitchen and living room, sure, but the income from those 2 rooms could easily cover your entire monthly housing cost and then some. I know people who are making an extra $1,000, $2,000, or even $3,000 a month in pure profit from their house hack after all expenses are paid, simply by leveraging the short-term rental market. That's life-changing money. Of course, this approach requires a bit more active management than a long-term rental. You have to manage bookings, communicate with guests, and ensure the space is clean between stays, but the financial upside can be well worth the effort. You can even automate much of the process with smart locks for check-in and by hiring a reliable cleaner. If you're willing to put in a little extra work, you can transform your house hack from a tool that simply eliminates your housing expense into a legitimate and powerful income-generating machine that pads your bank account every single month. Alright, so let's get into the third strategy, and honestly this one is for anyone out there who has the hustle but maybe not the piles of cash sitting in a bank account just yet. It's called partnering with money, or what the industry often refers to as sweat equity investing. The concept is incredibly simple but also profoundly powerful when you really break it down. You become the deal finder, the person with the expertise, the vision, and the willingness to do the work, and you partner with someone who has the capital but maybe not the time or the know-how to find and manage a great real estate investment. It's a perfect symbiotic relationship, a win-win scenario that leverages the strengths of 2 different parties to create wealth together. Think about it like this. There are countless people out there, doctors, lawyers, tech executives, you name it, who have significant savings and want to invest in real estate for the amazing returns and tax benefits, but they are incredibly busy. They work 60-hour weeks, they have families, and the last thing they have time for is driving around neighborhoods looking for sale by owner signs or spending hours on the MLS analyzing deals. They have the money, what they don't have is the time. That's where you come in. You bring the deal to the table, a thoroughly vetted high-potential property that you've already done all the homework on. You are essentially trading your time, your effort, and your expertise, your sweat, for equity in the deal. This isn't some far-fetched idea, it's happening every single day in every market across the country. I've seen it countless times. Maybe you're exceptionally good at finding those undervalued, off-market properties that nobody else can seem to locate. Or perhaps your strength lies in project management. You know how to coordinate contractors, stick to a budget, and oversee a renovation from start to finish. It could even be that you're a genius at tenant management, screening applicants, and keeping a property cash flowing smoothly with happy renters. Whatever your specific skill is, that is your currency. That is the value you bring to a partnership, and it's often just as, if not more valuable than the initial capital investment itself. The beauty of this model is its scalability and the low barrier to entry. You don't need a perfect credit score, and you don't need a down payment. What you need is a demonstrable skill and the ability to build trust with a potential partner. You're not asking for a handout, you're proposing a legitimate business venture where both parties have skin in the game and stand to profit handsomely. You do the legwork, they provide the funds, and you both walk away with a share of the profits. For anyone feeling stuck because of a lack of capital, this strategy completely shatters that roadblock and opens up a direct path to real estate ownership and wealth creation. Now, of course, when you decide to partner with someone, especially when significant amounts of money are involved, you can't just rely on a verbal agreement and a handshake. That's a recipe for disaster. The key to a successful and long-lasting partnership is to structure the deal properly from the very beginning, with everything clearly documented in writing. The most common arrangement in these sweat equity deals is a 50-50 profit split, but the specifics can be tailored to your unique situation. This agreement needs to be rock solid, outlining every single detail of the partnership, so there is absolutely no room for confusion or disagreement down the road. It protects you, it protects your partner, and it sets the foundation for a professional business relationship. Your partnership agreement, which should ideally be drafted or at the very least reviewed by a real estate attorney, needs to cover all the bases. Who is responsible for what exactly? Define your roles with surgical precision. For instance, your role might be to find the property, negotiate the purchase price, oversee any and all renovations, and manage the property post-purchase. The money partner's role is strictly to provide the funds for the down payment, closing costs, and any renovation budget that you've agreed upon. The agreement should also explicitly state how and when profits will be distributed. Is it after the sale of a flip, or is it from the monthly cash flow of a rental property? Get it all in writing. Furthermore, a critical component of this agreement is the exit strategy. What happens if one partner wants out? What if the property isn't performing as expected? You need to plan for the worst-case scenarios, not just the best. Your agreement should outline the buyout clauses, the process for selling the property if you both agree to dissolve the partnership, and how any potential losses would be shared. It might seem pessimistic to plan for things going wrong, but it's actually the most optimistic thing you can do because it ensures that no matter what happens, your relationship and your finances are protected by a pre-agreed upon framework. It removes emotion from future decisions. So, where do you find these money partners? Start with your own network. Talk to family, friends, colleagues, and let them know what you're doing. You'd be surprised who might be interested. Beyond that, local real estate investor meetups, or REIAs, are gold mines for networking. These events are filled with experienced investors and private lenders who are actively looking for people just like you. Ambitious individuals who can bring them good deals. Go to these meetings, introduce yourself, explain your value proposition, and start building those relationships. Your first partner could be just one conversation away, but you have to put yourself out there and make it happen. Let me paint a picture of how this works in the real world, because seeing it in action makes it so much more tangible. Let's say you've spent months educating yourself, you know your local market inside and out, and you've gotten really good at analyzing potential deals. One day, you find it. The perfect property. It's a distressed duplex in a rapidly appreciating neighborhood, listed for $300,000, but you know, with about $50,000 in renovations, it could be worth $450,000. The numbers are solid, the potential profit is huge, but you don't have the $350,000 needed to acquire and renovate it. This is where your sweat equity skills come into play. You take this meticulously prepared deal, complete with comparable sales, a detailed renovation budget, and projected profit analysis, to a money partner you met at a local real estate meetup. Let's call him Bob. Bob is a busy surgeon who loves the idea of real estate but has zero time. He reviews your proposal, sees the clear potential, and is impressed by your thoroughness. You both agree to a partnership. Bob provides the full $350,000 from his line of credit or savings to purchase and renovate the property. Your name might go on the title alongside his, or you might form an LLC together to purchase the property, which is often the smartest move for liability protection. Now, your sweat begins. You manage the entire project. You hire and oversee the contractors, you make sure the renovation stays on schedule, and more importantly, on budget. You handle all the headaches, the unexpected problems that inevitably pop up, and the day-to-day management of the project. 6 months later, the renovation is complete, and the duplex looks absolutely stunning. It's now the nicest property on the block. You list it for sale, and because of your hard work and the great location, it sells quickly for your target price of $450,000. This is the moment you've both been waiting for. Let's break down the profit. The total investment was $350,000, and the sale price was $450,000, leaving a gross profit of $100,000. First, you pay Bob back his initial $350,000 investment. The remaining $100,000 is the net profit. Based on your 50-50 agreement, you split that right down the middle. Bob gets $50,000 for providing the capital and you get $50,000 for your sweat equity, for finding the deal and managing the project. Just like that, you've made $50,000 in 6 months with absolutely none of your own money invested. You've proven your value and you can bet Bob will be ready to fund your next deal. This is how you build a real estate empire from scratch. Alright, so let's talk about the fourth strategy. And this one is for everyone who wants to get into real estate without ever having to unclog a toilet or screen a tenant. I'm talking about REITs, or real estate investment trusts. Seriously, this is like the stock market version of real estate and you can get started with less money than you'd spend on a few cups of coffee. Think about it. Instead of buying one specific property, you're buying a tiny slice of a massive portfolio of properties. This could include everything from giant shopping malls and office buildings to apartment complexes and data centers. It's the ultimate way to diversify your real estate holdings without needing hundreds of thousands of dollars in capital. So how does this actually work? Well, it's incredibly simple. REITs are companies that own, and in most cases, operate income-producing real estate. They are legally required to pay out at least 90% of their taxable income to shareholders in the form of dividends. This is where the magic happens for investors. You get the benefit of rental income and property appreciation, all packaged into a neat little stock that you can buy and sell on major exchanges. This means you get the cash flow of a landlord with the liquidity of a stock trader. You don't have to wait months to sell a property, you can sell your shares in seconds. The best part is the barrier to entry is practically non-existent. Forget saving up for a 20% down payment. With modern investment apps like Fundrise, Public, or even Robinhood, you can literally start investing in REITs with as little as $10. That's right, for the cost of lunch, you can become a fractional owner of a diverse portfolio of real estate assets across the country, or even the world. This completely democratizes real estate investing, taking it out of the hands of only the ultra-wealthy and putting the power to build wealth directly into your hands, right through your smartphone. It's a game changer for building a diversified portfolio from the ground up. And let's be clear, this isn't some niche, unproven strategy. REITs have been around for decades and have a solid track record of performance. They offer a way to get exposure to the real estate market's potential for long-term growth and income generation without the headaches of direct property ownership. You don't have to worry about finding deals, negotiating with sellers, managing repairs, or dealing with difficult tenants. The professional management team of the REIT handles all of that. You just invest your money, sit back, and collect the potential dividends, letting your capital work for you around the clock. Now let's get into the numbers, because that's where the real power of REITs becomes undeniable. When you invest in a REIT, you're not just betting on property values going up. A huge part of your return comes from dividends. Remember that 90% rule? That translates into a consistent stream of passive income being paid out to you, typically on a quarterly basis. This is cash flow, pure and simple. You can choose to take those dividends as cash to supplement your income, or you can do what the wealthy do and reinvest them automatically to buy more shares, compounding your investment over time. This compounding effect is incredibly powerful. Imagine your $10 investment grows and pays a small dividend. That dividend buys more shares, which then generate their own dividends, and the cycle continues. It's like a snowball of wealth rolling downhill, getting bigger and bigger with each rotation. Over many years, this process can turn a small initial investment into a substantial nest egg. This is how you build real long-term wealth without having to constantly find new capital to invest. You make your money work for you, and then you make the money your money made work for you too. It's the secret sauce of investing. But it's not just about the income, it's also about the diversification. When you buy a single rental property, your entire investment is tied to that one location, that one property, and that one tenant. If the local market takes a downturn or your tenant stops paying rent, your entire investment is at risk. With REITs, you're instantly diversified across hundreds or even thousands of properties in different geographic locations and different sectors of the economy. An office building REIT might own properties in New York, Chicago, and Los Angeles. A residential REIT could own apartment complexes across the entire Sun Belt. This massively reduces your risk. This built-in diversification means that if one property or one market is underperforming, the success of the other properties in the portfolio can help balance it out. You're not putting all your eggs in one basket. Instead, you have a very, very large basket with a lot of different eggs. For a new investor, this is one of the smartest ways to manage risk while still getting exposure to the incredible wealth-building potential of real estate. You get the upside of property ownership with a safety net that's nearly impossible to replicate on your own without millions of dollars to invest. Okay, so it's simple, it's diversified, and it provides passive income, but how does it actually perform? Let's look at the historical data because, honestly, the results speak for themselves. This isn't just about keeping up with the market. In many cases, it's about beating it. Over the last 20 years, publicly traded U.S. equity REITs have delivered an average annual return of 9.6%. Think about that for a moment. That's a steady, reliable rate of return that has weathered multiple economic cycles, including recessions and market crashes. It really demonstrates the resilience and long-term viability of real estate as an asset class. Now, let's put that 9.6% figure into perspective. A lot of people consider the S&P 500, which tracks the 500 largest U.S. companies, to be the benchmark for investment success. And while the S&P 500 has had some incredible runs, there have been plenty of periods where REITs have actually outperformed it. This is because real estate often behaves differently than the stock market. During times of high inflation, for example, property values and rents tend to rise, which benefits REITs. This can make them an excellent hedge against inflation and a stabilizing force in your overall investment portfolio. The beauty of this performance is that it's accessible to everyone. You don't need an inside connection or a secret algorithm. You can simply invest in a low-cost REIT index fund or ETF and capture the performance of the entire sector. This is passive investing at its finest. You're leveraging the expertise of professional real estate managers and the collective growth of the entire property market. It's a strategy that lets you build wealth steadily and predictably over the long term, without having to become a full-time real estate expert yourself. It's about working smarter, not just harder. So when you're considering your options for 2025, don't overlook the incredible power of REITs. For just a few dollars, you can add a professionally managed, diversified, and high-performing real estate portfolio to your investment strategy. You get the benefits of property ownership, income, and appreciation without the typical barriers and headaches. It's a proven path to building wealth that has stood the test of time and continues to be one of the most intelligent ways for the average person to invest in real estate. It's time to take advantage of it. Alright, let's move on to our fifth and final strategy, and honestly, this one is one of the most creative and potentially lucrative methods for 2025. It's called rental arbitrage, and it's a way to generate massive cash flow from real estate that you don't even own. I know that sounds almost too good to be true, but stick with me, because this model is absolutely exploding right now. The basic concept is beautifully simple. You sign a long-term lease on a property, like an apartment or a house, and then, with the landlord's permission, you re-rent that same property on a short-term basis on platforms like Airbnb or Vrbo. The profit is in the arbitrage, which is the difference between the fixed monthly rent you pay to the landlord and the variable, but much higher, income you generate from short-term guests. For example, you might rent a two-bedroom apartment in a desirable neighborhood for $2,500 a month. But by renting it out on Airbnb for an average of $200 a night, you could potentially bring in $6,000 a month, assuming full occupancy. Even with a more realistic 70% occupancy rate, that's still $4,200 in revenue. After your rent, you're left with a handsome profit, all without owning the property. This strategy is brilliant because it removes the single biggest barrier to entry in real estate, the need for a massive down payment and a mortgage. You're not buying the property, you're simply controlling it through a lease. Your primary upfront costs are typically the first month's rent, a security deposit, and the cost of furnishing the unit to make it attractive to Airbnb guests. This means you can get your first rental arbitrage unit up and running for a few $1,000s, instead of the tens or hundreds of thousands needed to buy a property. It's a way to leverage other people's assets to build your own cash flow machine. Of course, the key to making this work is getting the landlord's permission. you must be transparent and have a clause in your lease agreement that explicitly allows for subleasing on short-term rental platforms. Many landlords are open to this, especially if you position it as a win-win. You can offer to pay a slightly higher rent, guarantee that the property will be professionally cleaned multiple times a month, and assure them that you will handle all guest communication and management. For the landlord, they get a responsible, business-minded tenant who keeps their property in pristine condition. For you, you get the keys to a highly profitable business venture. So why is rental arbitrage such a massive opportunity specifically for 2025? It comes down to a major shift in travel and lifestyle trends that has been accelerating and is set to peak. The pandemic changed how and where people want to stay when they travel. The demand for generic cookie-cutter hotel rooms is being replaced by a surging desire for unique, local and comfortable stays. People want a place with a kitchen, a living room, and a bit of character. They want to live like a local, not just visit like a tourist. This is where short-term rentals shine, and it's a trend that shows no signs of slowing down. What's particularly interesting for 2025 is the explosion of this trend in suburban and secondary markets. For years, Airbnb was dominated by major city centers and tourist hotspots. But now, with the rise of remote work and leisure travel, blending business and leisure, people are looking for comfortable stays in quieter suburban neighborhoods. They might be visiting family, exploring a new area before moving, or simply looking for a work-from-home friendly space outside of a dense urban core. This opens up a massive, underserved market for rental arbitrage entrepreneurs. This suburban demand is your golden ticket. Landlords in these areas are often less familiar with the short-term rental market and may be more open to a proposal from a savvy arbitrageur. Rents are typically lower than in downtown cores, while the potential nightly rates on Airbnb can still be very strong, leading to even wider profit margins for you. You can find a beautiful 3-bedroom house in a great school district, sign a lease, furnish it tastefully, and market it to families or remote workers looking for a longer short-term stay of a week or more. The potential is absolutely enormous. Furthermore, the technology and tools available to manage short-term rentals have never been better. Dynamic pricing tools can automatically adjust your nightly rates to maximize revenue based on demand, local events, and seasonality. Smart locks and keyless entry systems allow for seamless remote check-ins. A whole ecosystem of apps and services has sprung up to make managing your rental arbitrage business more efficient than ever. This allows you to scale your operations, potentially managing multiple properties without being physically present, turning this from a side hustle into a full-fledged 6-figure business. Executing a successful rental arbitrage strategy requires a clear plan. It's not as simple as signing a lease and throwing up a listing. Your first step is meticulous market research. You need to use tools like AirDNA or Mashvisor to identify neighborhoods where the potential short-term rental income significantly exceeds the average long-term rent. Look for areas with high occupancy rates, strong average daily rates, and a clear demand driver, like proximity to a business park, a university, or a popular local attraction. Data, not guesswork, should be the foundation of your entire operation. Once you've identified a promising market, your next mission is to find the right property and, more importantly, the right landlord. Scour Zillow, Craigslist, and Facebook Marketplace for rental listings. When you reach out, don't just ask if they allow Airbnb. You need to pitch yourself as a business partner. Create a professional proposal that outlines the benefits for them. Guaranteed rent, professional cleanings, minor maintenance covered by you, and peace of mind. Offer to provide guest screening and carry extra insurance. Your goal is to make them see you as the best, most reliable tenant they could ever hope for. After securing the lease, the next phase is all about the setup. This is where you can really stand out from the competition. Don't just throw in some cheap mismatched furniture. Invest in creating a stylish, comfortable, and memorable experience for your guests. Think like a boutique hotel designer. Create an Instagrammable moment. Provide a welcome basket with local snacks and stock the kitchen with good coffee. High-quality photos are non-negotiable. Your listing's appearance is what will make a potential guest click book now, so every detail matters in maximizing your revenue. Finally, success in rental arbitrage is about 5-star hospitality. Guest management is everything. Respond to inquiries instantly. Be proactive in communicating check-in instructions. Have a system in place for handling any issues that may arise during a stay. Your goal is to collect a steady stream of glowing 5-star reviews. These reviews are your business's most valuable asset. They build social proof, boost your listing in the search rankings, and allow you to command higher nightly rates over time. Master this, and you can build a scalable, highly profitable portfolio without ever owning a single square foot of real estate. So, there you have it. 5 powerful proven strategies to get started in real estate investing, even if you're starting with nothing. We've covered everything from wholesaling and house hacking to leveraging other people's money, investing in REITs, and building a cash flow empire with rental arbitrage. The point of all this is to show you that the old excuses no longer apply. You don't need to be rich to start real estate investing. You need knowledge, you need drive, and you need a little bit of creativity to see the opportunities that are all around you. I want you to take a moment and visualize what's possible. In 5 years, you could be living off passive rental income, quitting that job you hate, and traveling the world. You could be flipping your 10th house, building beautiful homes and creating wealth with every project. Or you could be running a 6-figure Airbnb portfolio from your laptop on a beach somewhere, all because you decided to take the first step today. The gap between where you are now and where you want to be is simply a series of small, consistent actions. It all starts with the decision to begin. So here's your move. This is your call to action. If you are serious about building wealth and achieving financial freedom through real estate, the first step is to hit that subscribe button. We are dropping videos just like this every single week, packed with actionable advice to guide you on your journey. Second, drop a comment below with your single biggest real estate question. I promise you, we read and answer every single one. And finally, if you learned something new or felt even a little bit inspired, do me a huge favor and smash that like button for the YouTube algorithm. This isn't just another video. This is your path to financial freedom. This is your chance to change your financial future and build a life on your own terms. Don't let this be something you think about and forget tomorrow. Don't wait for the perfect time, because it will never come. The perfect time is right now. The opportunity is in front of you. Start now, build wealth, live free. Thank you so much for watching, and I'll see you in the next video.